9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Our top stories today, gold and silver in focus after last week's record crash, spurring a wave of buying from speculators in China. The dollar flats after rallying on Friday by the most since May.
China's factory activity unexpectedly slides into contraction as the economy struggles to pick up momentum.
Also ahead, NASDAQ futures under pressure after Nvidia's Jen-Hsun Huang says proposed investment in OpenAI was never a commitment.
And I'm Avril Hong, live at Singapore's first space summit, where industry leaders are discussing challenges and opportunities in the global industry. Stay tuned for our interview with Chinese satellite company GalaxySpace.
Parabolic, frenzied, untradeable. Those are just some words that we're not describing our work ethic, but really just about,
they do.
About this crazy rally and, of course, crash that we saw on Friday when it comes to precious metals. And I think we're extending those losses once again here in the Asia session. You got to wonder, the triggers seem to have been Kevin Warsh's nomination as the Fed chair.
The dollar strength, yep.
The dollar strengthening. But then again, we've been talking about how overstretched these markets are for some time now. Maybe we just needed some excuse. But where to next is sort of the next question to watch.
Yeah, you kind of have to brush off this playbook, which doesn't happen quite often, of course. How long does it take to actually get some of these shorts out in the market, some of the flush that's come through as well? Extremely crowded trades, right? And I think we had a guest on 2 weeks back who basically said you'd have to be extremely insane to get into silver, for example, at these levels, given the vol profile. And that was 2 weeks ago, right? That was $20 before this rally that took us to about 115 and such. And obviously we've crashed about $40 since that point in time.
And if you take a look at it, don't forget that a lot of this is very speculative driven, right? When you talk about what's happening from China and what retail investors are doing, and maybe that's what's driving a lot of the mania that we're seeing, and that, these are supposed to be safe haven assets. And they're trading like they're momentum trades right now. And it's because they're buying up all this, whether it's the physical gold and the like, and really kind of driving up the local prices at a premium here right now. I think even now, after that crash, some of the exchanges are still talking about that premium. So we're not actually that far off right now after that big plunge on Friday, too. So.
It'll take a few days. And I think you and I were talking about this specific. There's one, just as an example, there's one ETF in China, of course, in silver, that had to stop getting money in because it was trading at such a large premium to the price that it just didn't make sense anymore. And I think if you're just around Hong Kong as an example, right, people are lining up around the block to get their hands on, physical gold and what have you. So it just underscores is the retail money left hanging here, right, after the sort of squeeze that's taking place. Not to mention, too, separately, we did get, which is why I'm watching commodities specifically like copper, because this manufacturing gauge coming out of China was also not encouraging. It might worsen some of the, copper powered through 14,000, right? And I think the last thing you needed was a PMI out of China, which missed virtually every single estimate, which, we'll see how things play out. But yes, two big market stories plus all the geopolitical stories, of course, over the weekend, everything from Iran and, of course, OpenAI and also the NASDAQ futures don't normally fall this much for this time of the day, too.
That would have been our top story on some days without 100%. This precious metal crash, right? But then again, when you hear these lines coming through from Taipei and Jen-Hsun Huang being there and talking, it's more, it was more of a commitment, with their OpenAI investment. That certainly does leave a lot of question marks of where this whole AI trade goes from here on forward, too.
Yeah, well, we talked about it. Have a look at where we are. There we go. Copper out of the gates, falling out of bed. We're down about 2% on the LME contract. Gold coming up on your screens, just to distinguish the two. The top two things you'll see on your screens are the spot price, bottom are the futures. Divergence between the two, we are extending though as far as the spot prices are concerned. 84 right now. We were at one point, by the way, below 80 about an hour and a half back or so. Brent is also coming up. Yeah, we're looking at some pressure coming through as far as the price there is concerned. We're down 3% this Monday on Brent. We talked about copper, some of the contracts in Shanghai. We're down 7% on copper in Shanghai. How does dollar look? Coming up on your screens very shortly. Dollar is extending. Last we checked, some of the strength that's come through. A lot of the bulk, of course, came through on Friday. Commodity currencies like the Aussie are underperforming today. A look across the equity market complex, while this isn't as pronounced as an overlay in equity markets, we don't need the commodity spin-off to play out in equities because you have the OpenAI story and Nvidia comments playing out across NASDAQ, for example. We're up on the Nikkei 225 that might have something to do with the yen. Very quickly, the approach to the open today, A50 futures are looking like this. We're watching all things precious metals from the big names like Zijin Mining, the big copper names like Jiangxi Copper, some of the ETFs in between. We had the big listing, of course, last week, this gold ETF. So all those names will be in focus, and we'll get you those prices in about, let's call it 15 minutes from now.
Yeah, joining us now is Frank Monkam, head of macro trading and strategy at Bayou Commodities. Frank, it's great to have you. What a weekend. What a few weeks.
What a weekend.
What a few month it's been. I think it's one of the most volatile months we've seen when it comes to precious metals. Where is your head at right now on what to watch next?
Hey guys, thanks for having me. It's a pleasure to be on. As you know, we're here now because of kind of a bifecta of triggers, really, from macro headline volatility with Warsh being nominated as the incoming Fed chair, but more so because of how extended the market has been from a positioning standpoint, right? From a CTA systematic player standpoint. So it always leaves the market at very, very vulnerable to kind of any kind of macro driven headline. And we started the year obviously with a lot of geopolitical risks, risk events taking place with, the Iran situation, the Venezuela situation, the Greenland situation, and really investors have been, especially the retail community, has been really, really quick to jump on the bandwagon of gold and silver. Gold was a story that was really driven by central banks, and it was only a matter of time before we saw, retail investors jump in. And also, one thing that I think is not being talked about enough is how the fact that we're sitting here in a bit of a crypto winter, right? What that's creating is that all of the natural flow, all of the natural habitat for crypto flow has been shifted a little bit into chasing this metals trade. And when you see these kind of flush outs, they could be really, really vicious, especially when you start to see some gamma move kind of exacerbated the price action.
Yeah, so Frank, just on that note there on the flush out, people are trying to figure out whether they missed the boat on the rally and they were waiting for a dip to buy, and what a dip we got. Is this a time to be dipping our toes back into the gold and silver markets, or do I wait this out a few days?
Yeah, very good point. Listen, I think that the structurally and even secularly, I think the story is still the same, especially for the gold market, where we still have, fiat currency debasement issues, fiscal dominance issues, geopolitical risks does continue to linger, but you have to be cognizant of the technicals, right? I always say when you invest, there's really three parts to it. There's the fundamentals, which remain in check and very valid, the valuation, which right now seem to be a bit slightly rich locally here cyclically, but the technicals were really overextended. So I think that the thesis remained the same, but now we got to trade around the technicals. And when you see this kind of vol shocks, though, unfortunately, you got to be a little bit patient to dip, your toes back in, because these things take a little time to kind of settle. Because you start to see cascading, price action take place cross commodity. We're seeing even crude oil, being on the back foot a bit again today, and equities taking a bit of a breather here to the rally. So it's really going to be kind of a cross asset convexity price action type moves that we're going to see over the next couple of days, maybe a week and a half. So I think patience here is the key. It's a long-term, I think it's a long-term play here with precious metals, particularly gold. So dipping your toes too early could prove to be pretty pernicious. I mean, we're still right in this volatility vortex here for gold. Even though, we're seeing vol kind of, ease a little bit here, we're still, very much in this vortex, and one needs to be a little patient to allow things to settle down a little bit.
Okay, Frank, while we're in this vortex, what are sort of the indicators what are the most important indicators to watch, right? Everything from, investor interest, ETFs, inventory. I mean, what do you think is going to be the most telling signal to you now moving forward?
I think very that's actually a very good question. I think very specifically, we've looked at this, trade in gold and all different cohorts of the market that have participated to this. We know central banks have been leading the charge, and we always thought that ETF and retail play would be next to come. But the speed and velocity with which this cohort, steps into the market is very, very important and very critical. So I think this is kind of come in a very rushed way, where we're seeing volatility spike to the upside. So I think what I'll be watching is really the extent to which we're seeing just a slight bit of deleveraging from ETF, and maybe flows kind of calming down and returning to volumes that are a little bit more reasonable. I mean, if you look at silver, for instance, I mean the daily notional on silver last week on a weekly basis was $150 billion notional. That's just, these numbers are just out of this world, right? So when you're trading in that kind of environment, it's just not healthy. It could be bullish, but not healthy. So what I'm looking for is signs of market health from a liquidity standpoint, and just seeing the froth kind of come out in the market a little bit before looking to re-engage.
Frank, we were looking at possible risks that could turn the trade, and we got it in the form of suddenly a stronger dollar, which arguably kicked things off. Does the underlying thesis of gold and silver and central banks, does that hold if the dollar strengthens?
I think it continues to hold. I think the pace at which the rally would extend would probably slow down a little bit. But you have to remember, central banks have made a commitment to do this, and they tend to be pretty price agnostic, right? So unless the fundamental drivers that have pushed sovereign players and central banks to adopt the thesis on gold were to change, I don't think the trajectory would change. I think the momentum and the speed of the rally could stall a bit, but the direction of travel is not changing unless the underlying fundamentals were to be altered in some fashion.
Frank, what do I need to look at in terms of the speculative trading that we're seeing in China, for example, when it comes to gold and silver? Should I expect that sort of demand to revive itself? I mean, we are heading into the Lunar New Year. That's where, you are seeing traditional demand for these sort of, gold and silver. But do you think after the shock sell-off, will they come back in?
I think so. I think it'll be probably a return with a little bit more pace, and it'll be maybe less hot sort of hyper speculative money, because it's speculative and hyper speculative, right? I mean, we start to see, daily volume pick up in the form of day trading and highly speculative investors. But I think retail continues to view gold as having a rightful place in investors' portfolios. And like I said, unless the dynamics that are have provided tailwinds to gold from a secular standpoint were to change, I think that the story will continue to be the same. But we need this stuff to settle. However, I think that there could be a few tail risks that could potentially derail or pause, retail flow in gold. It's one is, I think we need to continue to observe how the crypto market continues to trade. Are we really going to find ourselves in an extended, winter for crypto? I think that has a lot of, kind of cross asset flow implication into commodities, particularly gold. And secondly, I've mentioned this before on the air, I think a couple of weeks ago. I still think there's a decent risk of a reset in rates volatility here. I think we're seeing a bit of a calm here before the storm potentially. I think Governor Warsh being now the nominee, some people see him as being more hawkish, but also I think one of the things that the market hasn't fully discounted is the fact that he's probably looking to get back to more of the the Bernanke type Fed communication style, which is not so much guided by forward guidance, no pun intended, but really kind of a go policy as you go type style. And I think markets haven't really seen that in a while. And that could be another volatility catalyst here, not just for the rates market, for broader macro markets in general. And that could have an impact potentially on the gold market, particularly as it pertains to retail investors.
Frank, fantastic. Thank you so much for joining us on your Sunday, weekend, right? Frank Monkam, their head of macro trading and strategy at Bayou Commodities. In fact, just ahead here, we'll get into the Fed angle to the story here as commodity markets are continuing to be tossed out the window this Monday morning. Billy will be joining us in a couple of minutes to talk us through the dollar, rates, and monetary policy. Counting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong, futures are pointing lower. Commodities, again, falling out of bed this Monday morning. The opening bell 15 minutes away. This is The China Show. Right, welcome back. Precious metals. Not as precious as this time last week. That's certainly the case. Gold spot down 4, silver's down to about 82, was down below 80 at one point. The rest of the commodity space not doing, well, quite poorly too, if you think about it. Copper's down about 7% in Shanghai. The dollar is stronger, and we're just getting the fixer today coming through out of the PBOC, stronger than the estimates for the first time since November. So perhaps giving markets leaning into the weakness. That's still a question mark, but the dollar is still continuing to strengthen. It's certainly a good talking point today.
Yeah, let's bring in Bill Lee, Chief Economist and Managing Director at Global Economic Advisors. Bill, it's always great to have you. It seems like what we're seeing, this plunge in metals is a lot to do with the dollar strength that has come through. And that trigger point was really Kevin Warsh being the nominee named as the next Fed chair. Your thoughts on overall this, and do you think some of these moves in the dollar are sustainable at this point?
I think these price reactions are really a positive reaction to the fact that I think Trump picked the right guy. That Warsh is going to come in and do some pretty incredible changes, I think, to not only the way monetary policy is being conducted, but also the way the Fed has been operating for the last 10, even 20 years. The mission creep that people are worried about, that the Fed is no longer just concerned with monetary policy and supervisory, but they've gone into climate change, DEI, and a whole bunch of other issues. It's bloated the Fed budget by about 4 times, right? 4 times in the last 20 years, which is much faster increase than government expenditures or inflation. And Governor Warsh has always been complaining that a central bank that's operating properly should never be in the headlines. They should be in the background, and they should be keeping inflation contained, and they should be keeping the financial system safe. And I think that reaction is coming through the financial markets and saying, hey, the Fed's going to be refocusing itself again. Maybe it's going to be the Fed that we knew back then when things were really going well.
So, Bill, a better run Fed means what in terms of rate direction?
Yeah. I think there's something which I call the Warsh maneuver, and that is that he can lower rates pretty significantly and not be inflationary, because his main concern is that the large inflationary pressure is built up from the huge balance sheet, that the Fed has flooded the financial system with so much liquidity post financial crisis of 2008 and QE2 that the Fed never withdrew that emergency liquidity, and that liquidity has been feeding the embers of inflation for all this time. And I think he is determined to control that balance sheet and shrink it down so that it's a more manageable size, that is less inflationary, which means that he can actually allow rates to drop, so people can get lower price loans, mortgages can be lower, business loans can be lower price, more affordable, and at the same time be non-inflationary because he's draining liquidity.
Can you tell us a bit more about his style? I think we just had our previous guest said, traders in the market might not be used to, he sort of is a reminiscent of Bernanke, right? He's much more maybe reactive, not so much in terms of giving forward. Maybe you can tell us a bit more about his sort of approach to communication.
Yeah, I think the key indicator of where his style is going to be was what happened after the financial crisis. Bernanke came out and said, look, we need to continue to grow the balance sheet, give support to the economy. And Warsh said, look, if I were in your seat, I wouldn't be doing that. But I'm not going to be dissenting on the FOMC, but instead I quit. Because I don't believe in what you're doing. So I think that is an indication that Warsh really is a man of principle. He really believes that the balance sheet is the root of all inflationary evils. And by having emergency liquidity, which is when we needed it in 2008, that was a good thing. But after the emergency, you're supposed to bring it back to a more normal level. He likes to tell everybody, when he first got on the board of governors, the size of the balance sheet was under $1 trillion, closer to maybe $800 billion. It's now 10 times that size. It's really huge, and no effort has been made to hold it back. So I think that's the message I think he's been trying to deliver to financial markets when he was in the private sector, and I think that's the message that he's going to try to convince the FOMC that they really have to start correcting their previous sins.
The difference between his role during the GFC and the one, assuming he's confirmed, of course, as he said he comes in as the chair, it would be more difficult, Bill, to quit as the chair than it was, perhaps, if you don't agree with the chair. Now, but I wonder also, as the chair, right, he has the job now. He needs to deal with the divisions within the Fed currently. And how does his previous experience inform you about how he's able to do that job?
because he comes in with that reputation as a man of principle, I think it allows him to escape that notion that he's under the thumb of Donald Trump. That he's going to be doing Trump's bidding, because after all, he really he sacrificed his career at the Fed at one time to stay with his principles, and he is a principled man in the sense of wanting to restore price stability. Now, I think the composition of the FOMC right now is one where they themselves are pretty gun shy. I think this last meeting, if anybody had actually voted to drop rates, that would give them. Give markets the impression that they have become under the influence of Donald Trump, because I don't think anyone else on the committee has that principled reputation that Warsh comes in with. So I think he's got a huge task ahead of him. He's got to make the intellectual case to the committee, because that's how the committee works. From the time, even when I was at the Fed and you had a strong man like Volcker in charge, he still had to convince the committee to do what he thought was right. At that time, it was raise like crazy and do something completely unprecedented. Warsh is facing that same issue. And if he pulls it off, I think he'll be the most consequential chair since Volcker.
Bill, thank you. Bill Lee there, Chief Economist and Managing Director at Global Economic Advisors on Kevin Warsh. And we're talking a bit more about what has this sparked, right? This sort of precious rally crash, or you could say it's extending for another day. We are seeing when it comes to the Hang Seng pre-market opening up, we're down 1%. It's the gold miners that probably is driving things lower here. Zijin Mining, for example, I think is down some 10% as well. There you go. Massive declines of some of these miners here this morning, as it seemed like things were looking better in terms of the precious metal space. And then the China futures markets opened and things had started south again. Plenty more ahead. This is Bloomberg. Some stocks to watch is no surprise here. Continues to be what we're seeing across the miners here this morning. Zijin Mining, as we talked about, we're down some 10%, and the silver miners are not doing quite well as well. We're down 4% for China Silver Group. So we'll continue to watch. Seems like right now investors are not really willing to buy the dip right now. Copper stocks also, as we talk about here, just opening up lower when it comes to copper. That might be kind of due to the PMI data that was weaker than expected and back into contraction for January out of China. Copper's down close to 3%. Here you're seeing Jiangxi copper down some 7%.
Yeah, certainly did not help that we got that sub 50 number on the PMI numbers. What you don't see on your screens too, we talked about most of the commodities, is energy is actually down also quite substantially this morning. Oil prices are off over 3%. So we'll see what it looks like as far as the open is concerned. That's coming up next. This is Bloomberg. Good morning. Okay, so it's a tough and rough day to be long commodities today. I previously used this visual of, you know how you feel when you pluck your nose hair?
Oh gosh.
So you imagine that, but combining that with slamming your pinky toe on the side of the bed. That's what this commodity,
like.
Combining those two things is the visual iteration.
I was just thinking
commodity
it's just
markets
one long
today.
hangover, like once you reach the age that we are, Dave, it takes more than a day to recover.
I even just smell a beer and I get a headache for 48 hours.
The average 2 to 3 day hangover. We're feeling that across these markets, right? When it comes to precious metals and what we saw on Friday. One of probably the more wildest days we've seen when it comes to gold and silver prices and how much we actually, the scale and the speed of those drops, it looks like we're extending that into the second day in the Asia session on this Monday morning. And as soon as some of those futures markets in China opened up, I think we further saw more selling. So certainly it's one that may take a few days and weeks, according to our guests, for things to really sell right now. The speculative buying that we're seeing, or at least selling that we're seeing from Chinese retail investors, is going to be one indicator to watch as we approach, of course, that Lunar New Year, a traditional time to actually buy gold, right? So are we going to see that interest still be quite strong, and where the demand picture looks like here? But you're seeing when it comes comes to commodity markets, as Dave mentioned, we are falling out of bed on this Monday morning. Monday blues for sure. Copper's down some 7.5%. Shanghai crude is also down 5%. Iron ore is down 1% as well. And we're seeing, of course, as we talked about, the gold miners are all selling off this morning, if not all, if not most. Shanghai is down about 0.8%. So the equity space certainly being roiled. I mean, you take a look at the tech space. There's the Nvidia comments from Jen-Hsun Huang in Taiwan, and really kind of people questioning the amount of commitment into OpenAI and the like. So once again, it's adding a lot of question marks to the whole AI sort of story thing as well. We also got some prelim numbers from Capricorn, for example, here. Well, you're talking about triple digits in terms of growth, and it was also when it comes to the guidance there, but still the shares are down some 1%. Flip the boards to see how Hong Kong is doing. Looks like we're seeing a more pronounced selling when it comes to the Hang Seng. We're approaching that 27,000 level for the benchmark as well. HS Tech is selling off. Most of the big names are seeing declines there more than 1%, and Tencent, Baidu, Meituan, Xiaomi as well. We did get some BYD numbers also, which were not pretty weak as well when it comes to car sales.
Oh, God.
Dollar China at least is holding strong. Despite some of the dollar strength that we've seen. I mean, that was kind of what sparked this whole selling in precious metals was this Kevin Warsh nomination, dollar bid up. And then, of course, crashing in precious metals. But we're still holding around 695 levels for renminbi here this morning. So still one to watch. Even property today not doing so well.
Yeah, that's despite, of course, we had a banner week last week, if you think about it, right, on that report on the 3 red lines. And I think when you look at, I think the fix that Yvonne mentioned, too, as far as the renminbi goes, it was the first time since November that the PBOC set the midpoint stronger than estimates. Apart from this, I mean, gold and silver stocks coming up on your screens. I'm looking almost everywhere across the resource materials space, and I'm struggling to find a bright spot here. So CSI 300 materials index down about 5. Oof. Some of the big names, and it's worth pointing out, right, some of these names, if not all of them, have done tremendously well going into this weekend where everything suddenly just got squeezed at the downside. So we're down about 5 on these. Some of the ETFs, for example, that we've been tracking. We were joined last week, of course, by the CEO of Hang Seng Investment Management when they, of course, launched that ETF that's coming up on your screens, and how, yikes. Okay, BYD. Geely, Neo, Great Wall, all coming up on your screens also on the back of those numbers coming through. Let's have a look at that. There we go. Okay. Not as bad, but okay, I'm trying to be generous here, but the price action is not doing me any favors. What is, though, I'm looking at my stocks, what is managing to buck the weakness overall. 101 HK did open up 2-3% to the upside, slightly weaker now. We're looking at the property sector. We talked about this, right? After the developer gauge rallied around 15% just in the last month, they've been led broader by they've led the broader Hang Seng Index as well as this gauge of mainland real estate names.
And part of that rally is Hang Lung Group, as we talked about, right? Yeah. 101 HK reported a 3.4% increase in underlying profit for 2025. Here to join us to tell us more is Adriel Chan, chair of Hang Lung Properties. Adriel, it's always great to have you. We're seeing a bit more price discovery, at least in the Hong Kong property market, and we're starting to see the market kind of sense that in some ways that there might be some recovery underway. Do you think that we've found a bit of a bottom?
It feels like we found a bit of a bottom. Definitely, if you look at our retail sales numbers, they've been coming back. Second half last year was strong. Fourth quarter was especially strong. We broke records in terms of occupancy, foot traffic, and retail sales. So it does feel like it's coming back. Hong Kong a little bit weaker. We're still finding the bottom there. I think we've found it, but we'll have to see how the retail numbers come out these next couple of months. So overall, mainland China definitely giving us cause for some hope. Yeah. That being said, I think the numbers are strong, but we're still a little bit careful on the outlook.
What assumptions are you making on mainland retail leasing specifically, along the luxury space, of course? You mentioned that's a bright spot for you guys. So
for January so far has been a little bit down, basically flat from last January. Okay. The bright spot is that January last year was Chinese New Year. This year, Chinese New Year is in February. So we're hoping that means good retail sales uplift, and we think that it's tracking.
It looks like you've been quite active in expanding your China retail leasing portfolio, right? Cities like Shanghai, Hangzhou, Wuxi. How do you compete with some of these domestic big names? and big developers and landlords like China Resources Land, for example, in this market?
So the way I describe ourselves is we're small and beautiful, so we have to do things in a slightly different way. Definitely, we don't have the scale. Everything from finance cost and access to capital is different. So we have to really try to stand out in terms of doing things as high quality, as niche, and as high end as possible. And that's what we continue to do. What we've announced recently is our V3, which is starting an asset light path, and this is definitely going to make better use of our capital, especially when that's constrained. We're working on reducing our gearing, and the question is, how do you expand while reducing your gearing? And that's basically with asset light. So that's what we've been doing, and only in the cities where we have the strongest presence and the best performance already. So that's where we're working to expand.
How does that, so what does it mean as far as the business model is concerned? So you mentioned asset light. So try to explain that to a 5-year-old, for example.
Yeah, so if I go back, our last version 2, was really asset heavy, where we'd buy a plot of land, we'd develop it, and then we'd lease it. So this is really where we're leasing the plot of land or leasing an existing mall and operating it. So if you look at China real estate prices, they feel like they've topped out. It's hard to see a lot of upside in the near to medium term, and therefore, so we used to want to capture that capital upside, and now we're more about capturing the operational upside. So increasing our operational exposure without having too much capital exposure.
You mentioned Hong Kong's recovery might be a bit maybe not as solid right now as mainland and what you're seeing. At what point are you going to start looking at maybe opportunities then? I mean, are you looking to sell more properties or even acquire any new projects in Hong Kong this year?
So in Hong Kong, we've really been working hard to sell. Last year, we actually sold a lot. We contracted a lot of sales, but we're not going to recognize a lot of it until this year. So last year was actually a good year for sales, but that'll be recognized this year. We're looking to sell down more. We still have some properties for sale, mostly on the high end, but we have some remaining in aperture. So that's what we're looking to do. Obviously, if good opportunities come by, I think we're happy to buy as well. We do feel like the markets have bottomed, or at least we found the bottom on this round.
What do you think is driving this recovery?
So in Hong Kong,
who's buying?
In Hong Kong,
yeah, in Hong Kong, there's a lot of mainland new Hong Kong people coming in. The talent scheme has definitely brought up rental levels, and as these people have rented now for a couple of years, they may be looking to buy. These tend to be slightly higher end buyers, so I'm more bullish on the top end of the market than I am on the mass. I think the mass has seen sort of a structural re-rating over the past couple of years. It'll be some time before that comes back, whereas I think the high end is definitely more cyclical and therefore more resilient for us.
I mean, it's really been noticeable, the pickup in visitor flow, let's just call it, tourists and businesses, and we've had a lot of mega events. We're moving into March, where traditionally it's like a mega event month, right? You have everything from Art Basel all the way to the 7th. Tangibly, is that starting to show up as far as, you talked about foot traffic, but what about leases and retail sales, for example? Is that starting to pick up too?
We're really happy that foot traffic has picked up. We're not as happy at the retail sales. They haven't picked up at the same pace that traffic has. It's usually a lagging indicator, but we're going to have to work harder to transmit those foot traffic into sales. And right now, the appeal of Shenzhen is still strong. Hong Kong people, even though it sounds like they're going up a little bit less, it's still difficult to compete on price.
You were still able to maintain your occupancy rate during these turbulent times, right? 90%.
Offices,
of your office portfolio, despite the headwinds. But revenue was still kind of edging lower, because of falling rents, of course. Do you think that that's the next place to follow in terms of this recovery? Now that we've seen, at least when it comes to the housing market is recovering, that maybe rental is going to be the next thing to watch?
I would really like for office rents to rise this year. That's what's really.
I like how you started that answer already.
That was really what dragged our numbers last year, because offices have been tough, both in Hong Kong and in the mainland. It actually took away some of the gains that we made in retail. So retail's done well, offices not so much. I don't see the end in sight for offices just yet. Of course, here in Hong Kong, we're talking about the IPOs and the financial services industries helping with that occupancy. But there's still a lot of occupancy, especially here in Central. And so I think occupancy has to come up before prices are going to come up. And I don't yet see the end to that.
And the strategy to maintain the sort of 90% occupancy rate, do you think that's going to be down to price, supply seems to be an issue, I think, is what you're mentioning too.
Yeah, so I think there's still going to be a little bit of price pressure because occupancies haven't fully caught up yet. In the mainland of China, it's also tough. Offices, I think it's, I've had this discussion with a lot of my friends and peers. Is it cyclical or is it structural?
Right.
And when you're having that discussion, it's not a good discussion to have. That means that things are bad. And so I don't yet see the end for office rentals in China yet.
What is the answer to that, though?
Yeah.
Is it cyclical or more structural? You think?
My answer is actually that it's more cyclical. And I think that if the economy comes back, when it comes back, office rents will come back. There's still that dynamism. And if they can reignite that, then I think that offices can come back, at least at the high end of the market.
You mentioned just now, the IPO market's come back. That's actually come up quite a bit in our shows. People talk about how a lot of these firms listing here will need office space. Brokerages are expanding their headcount and hence, hopefully, office space. How has that translated? Not so much on demand itself, but just conversations that you had with your peers.
It's definitely helpful, but for the time being, I think I'm having more conversations than signing so many deals. Exactly.
Okay.
I mean, it's a good start, I guess.
It is. At least we're talking about it.
Yeah, it's good to have you here. Thank you so much for all your insight and the skater shop. Can you tell us more about that?
852. We have a skate shop here in Hong Kong. That's a lot of fun.
I love the name.
But retail is kind of coming back a little bit.
Okay.
852.
852.
Go check it out. For all you homies out there. I love it. If you haven't seen Adriel's, Instagram, it's all skateboard.
Yes. He doesn't look like that most of the time.
But we love it.
In a good way.
Adriel, thank you. Adriel Chan, Chair of Huang Properties there. Breaking it all down on what the outlook looks like. Coming up, we're talking about Nvidia CEO Jen-Hsun Huang saying its investment in OpenAI's next funding round may be the biggest yet. More in his comments from Taiwan next. This is Bloomberg. All right, we've been tracking, of course, as we all do, always, when Jen-Hsun Huang is in this part of the world. We track everything, right? From where he eats, what he says, all the like. Nvidia CEO did talk about some comments and details about the firm's commitment to OpenAI, which did in some ways is now kind of moving the markets, right? This comes after the Wall Street Journal report that Nvidia has planned to invest up to $100 billion had stalled. Now, speaking in Taiwan, Huang told reporters the company would definitely participate in OpenAI's latest funding round.
Sam is closing the round, and we will absolutely be involved in
How much? Can you say how much? Can you say how much?
We will invest a great deal of money, probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
All right. Some of the comments, maybe the lack of details, some of the reporting suggesting that I think when you look at U.S. futures right now, perhaps underscoring why that cohort is underperforming, but it's also not a good day to be in long these markets anyway. For more on the Nvidia story, joining us here is Belle, of course, our Asia Tech correspondent. What else did Jen-Hsun Huang say there?
Yeah, I guess he was sort of giving at least you could say, a very big clarification, essentially. So what he's talking about here is this a letter of intent that was signed back in September of last year. And in that, it was OpenAI and also Nvidia that essentially committed to this big build-out of data centers. So Nvidia was looking, or OpenAI rather, was looking at adding 10 gigawatts of AI data centers, and they were saying they're going to be using Nvidia systems for that. Now, in that letter of intent, it also said that Nvidia would invest up to $100 billion, and that's the part that Jen-Hsun Huang is really being a question about quite forcefully, especially after that Wall Street Journal report. But how serious is that commitment? What's the size of the commitment? He's saying that it could be up to $100 billion. It's definitely not going to be $100 billion in the first round, and there's definitely concerns that maybe they're actually cooling maybe a bit more than even he's expressing in that soundbite there.
Tell us more some of those reports. What are the concerns about this? The level of commitment to to OpenAI now?
So it was a Wall Street Journal, as you said, and they put out a report on Friday, and essentially in that they said there's concerns about the competition that OpenAI is facing, and we know that, of course, from the likes of Gemini, for instance, from Alphabet. There's also concerns around the way, or we're hearing, or what the Wall Street Journal is saying, according to their sources, that Jen-Hsun Huang is expressing in private, is the way that OpenAI is being run, and some concerns maybe around their fiscal discipline at the business. They're two of the different concerns. But what we're also hearing from the Wall Street Journal is that what they're reporting is that the talks following that letter of intent that was signed in September of last year have stalled. And that is sort of also one of the key questions from that.
What about the relationship between them and DeepSeek? He was asked to comment on that too.
Yeah, so this was also probably wasn't his. I mean, he's always very amenable with the reporters, but he certainly did get a lot of questions on the reports. So this is another one that came out on Friday, and it was essentially the top Republican on the House China Committee who wrote a letter to Howard Lutnick, essentially expressing concern that Nvidia had helped DeepSeek on its R1 model. R1 model, of course, is the model that was released around this time last year and really caused a big flurry. We haven't seen R2 just yet, but he said that Molinar said that Nvidia had aided in that effort. But just take a listen to what he had to say about that.
Our software is used by developers everywhere, and on that basis, then of course, every developer uses Nvidia software. They use Nvidia software from CUDA to cuDNN to TensorRT-LM, and so whenever developers want to use our software, we openly support everyone. That's our job, supporting developers, every developer, and we support developers all over the world. We have 5-6 million developers around the world. Every AI developer in the world works with Nvidia, and so I'm very proud of that.
Yeah, so if anything, he's not pushing back on that comment. He's more just saying, yeah, that is something that we do. We work with developers, as he says, all around the world. So that was just some of the commentary. And Jen-Hsun Huang, of course, in Taipei over the weekend after that trip to China last week.
I mean, it's never easy to when people force you to define a relationship. But anyway, Belle, thank you so much. Isn't it? Right?
Now you sound like a commitment phobe, to be honest.
I mean, at the same time, you mentioned letter of intent, right? Like how that's almost like a situationship if you think about it, or a memorandum of understanding.
Yeah.
Right? If you think about it, like how like legally committed are you really?
Well, that was the thing. He said that it's non-binding. That's what we're hearing. That he was emphasizing behind closed doors.
That's the point I was making.
Okay,
there we go.
Many terms of ways to describe relationships these days, right?
Yeah. Just don't. There's no need to define it.
It's just getting very complicated, basically.
Okay, Belle, thank you so much. All right, we opened up a can of worms there.
We did.
On the tech story. All right, RatingDog PMI's out. The backdrop here is the official numbers, services, and non-manufacturing, manufacturing missing estimates. This one actually coming in above the estimates here. In fact, at the very top end of estimates, 50.3 as far as the RatingDog PMI is concerned. We are getting some strength coming through in the Chinese currency on the back of stronger fix, and then perhaps on the back of some stronger numbers coming through just now.
Yeah, at least when it comes to private gauge, things are looking a little bit better. We'll break down what looks like under the hood. BE basically came out with their note on the official PMI numbers that came out saying, look, if you look beyond just the headline, it's actually worse.
Oh, yeah.
So we'll get Cheng-Shi and her team on eventually one day to talk about that. When it comes to commodities, it's still kind of the front and sort of thing in front of investors' minds here this morning. It is still seeing quite a sell-off here when it comes to Brent, copper, aluminum, precious metals, everything, right? So certainly that's going to be one to watch here. It's not just a precious metal story. You are seeing the entire commodity complex in some ways feeling worse. But actually gold and silver at least, right? You're seeing it, and the futures have actually stabilized a bit and seeing a bit of recovery there.
Yeah, we're up 7% now in futures.
Yeah.
Okay, 10-day vol is highest in at least 45 years there on silver. This is Bloomberg.
Here are some stories we're following for you today. Bloomberg has learned that Alphabet's autonomous driving unit is aiming to raise about $16 billion in a financing round, I should say. That would value Waymo at nearly $110 billion. Sources say Alphabet will provide about $13 billion, while the rest would come from outside investors, including Sequoia Capital, DST Global, and Dragoneer Investment Group. BYD has reported a 30% drop in sales in January, delivering just over 210,000 vehicles. The figures underscore the challenges facing the EV maker's efforts to boost sales, just as a winding back of subsidies hurts demand in China. Now, analysts still expect BYD's total sales to rebound to more than 5 million units this year, up from 4.6 million last year.
Yeah, as you can see, we're down 5% on BYD. How is the rest of the sector an industry group doing? So not much better. In fact, so much worse. When NIO shares are down about 6%. So it's not just BYD, right? This broad group did come out with January numbers that have come out. There we go. NIO, for example, deliveries versus the previous print, which was closer to 50,000. We're closer to 25, specifically on NIO. Macau casinos, though, speaking of something that beat estimates, were up there as far as casinos are concerned. So enough to buck this downtrend we're seeing across risk assets today. So gaming revenue coming in higher than estimates. Apart from that, it's very difficult to find a bright spot across these markets. And I think this topsy-turvy session we're seeing in precious metals prices underscores this. We are extending the weakness from Friday, of course, as pertains to some of these spot trades here.
Yeah, well, a lot more on the way in the next hour. You're watching The China Show. Welcome back to The China Show. Here's a look at the HSI half hour into the session. And yeah, I mean, we're sort of just seeing a bit of pessimism. This wave extends beyond just the commodity space here right now after what we saw was that massive crash in precious metals on Friday. We are continuing on here today after the biggest plunge in silver prices on record on Friday, biggest drop for gold in a decade. There is some silver linings to this. The pun. Silver linings is that silver futures at last check is actually rebounding here right now. Yeah, what is the playbook then? But right now we are seeing at least gold futures as well, all now at least in positive territory. So is it a sign that maybe there is a bit of dip buying? Is there signs of things looking a little bit better? Certainly that may take a few days or weeks, according to our guests, for things to really settle right now. But right now, there's a lot of questions about, the retail investors and have they been sort of scarred after what happened on Friday, especially some of the speculative traders that we've been seeing in China, too, and the activity there. Yeah, that really got in. And I think anecdotally, right? So a good example that I would imagine is the experience of many retail investors, right? So, for example, if you want to subscribe to a precious metals fund at your bank, for example, right? You put the application in, and then you wait a few days until you get the allocation, right? So imagine people who put in an allocation to a precious metals fund on Friday, and then the weekend happened. They're probably scrambling to tell the bank to cancel that going into, at what price, right, too. I think that just to say that flush it takes a while. Yeah. And the advice from our guests earlier on said, let's wait until this settles, until there's clear indication of where this settles. And then we can make a decision based on fundamentals, which haven't changed. But it's so interesting, right? Because this is such a market that is so liquid, but yet you're seeing price declines in the scale and speed that we saw, right? Double-digit sort of losses, which we really haven't seen when it comes to, history, right? And so certainly it's going to lead to a lot of questions. I think longer term, is this really going to be a safe haven instrument, given that it's been trading much more like momentum than really safety at this point? It needs to stop behaving like this, I think, to become a haven asset, right? I think is the market broken? Fantastic story
from our colleagues, right? And I like the way they started it. For the better part of the silver's history, it was trading below $40.
Yes.
It dropped by $40 in one day on Friday, just to underscore the point.
And our guest Frank earlier was saying, there's a lot to do with crypto in all this as well,
yes,
right? Because crypto was largely seen as the alternative to gold. But it has not in any way performed like gold in the last couple of weeks or so. In fact, it's actually been divorced from what we're seeing in this whole precious metal rally. So the cross-asset flows has a lot to do with what we're seeing with Bitcoin, too, and why maybe a lot of people are so quick to pile into gold leading up to before this crash.
Yeah. Okay. Well, things are moving all over the place. 1.3% on silver prices, right? For the most part, we were able to ignore the Fed until they forced us not to ignore the Fed and the stronger dollar, which really caused why we're trading at these levels. Separately, though, there are lots of other stories taking place. You had Iran, you have India, and you have Indonesia. Let's have a look at India. Of course, the budget was out over the weekend. Futures are coming up on your screens very, very shortly. Lots to unpack there. Flat on that. Jakarta is coming online. Nomura, the latest bank to downgrade the market following peers like HSBC, like Goldman Sachs. Indonesia, the resignation, of course, of the exchange CEO, 1.6%. A little bit of normal moves following what was far from normal when you look at the last 2 or 3 trading sessions there. But the metal space continues to dominate, of course, headlines. It's one of the most, a lot of the metal stores are top red across the Bloomberg terminal today.
Yeah, and there certainly is that China angle to all of this as well. That makes it particularly more interesting.
Yeah.
Let's bring it back to that discussion, really, and where to next. Let's bring in our metals and mining reporter, Martin Ritchie, in Shanghai. Martin, I'm guessing you didn't have much of a weekend, as most traders have had, just given this historic sort of moves that we're seeing across precious metals. Let's talk about the China angle, of course. A lot of it was speculative driven. What are the retail side, and what are you hearing right now on what comes next? Is there still going to be that demand for gold after this shock sell-off?
I think when you've had such intense volatility as you've had over the past few days, with prices really moving out of any kind of expected range, you're now in this kind of strange scenario. People are just wondering where the bottom is. Just 2 days ago, wondering how high things can go, now how low things can go. Things are reasonably, relatively stable this morning. We've seen silver go down 12%. Obviously, a week or two ago, that would have been a big move. Now, not so much. We are waiting to see across the complex. I think that includes base metals and precious metals, where Chinese investors who've been driving the kind of sentiment recently will start to buy the dip. That's what everyone's wondering, because as you've alluded to in the previous discussion, it's maybe less a physical trade, a fundamental trade now than it is about momentum. And so it's going to be a big signal if we see the Chinese fund flows coming back in. The other complication, I guess, is that there's the Lunar New Year coming up, the Chinese New Year, as of next week. So there's only a few days left. And I think there's a sense that even if there's a kind of bullish long-term outlook, there's maybe some kind of cutting back on risk exposure over the coming days.
Martin, our guest earlier talked about how we can maybe save the fundamentals conversation for next time until this settles. And he was talking about technical levels to watch here, because that seems to be what the market is focused on. Are there specific levels you think we should be tracking, both for gold and silver here?
I wouldn't like to put out my own view on where technical levels are, to be honest. I think that the market's looking for just that kind of that point at which China's fund buyers start coming back in. For silver, we're already back down towards the 80 levels. You could see something below that being a trigger, but it's very hard to say at this point where those levels are going to be.
Okay, well, let's wait for the dust to settle, Martin. It's that kind of day, isn't it? Martin Ritchie, fantastic. Thank you so much, sir, out of Shanghai for us, just to underscore really the enormity of these price moves we're seeing in silver, for example, right? 10-day vol on this is at the highest in at least 45 years. So the point Yvonne was making, is this a safe haven asset? It needs to stop acting like it's not a safe haven asset for that to come to fruition. The chart should be coming up. If not, we can talk about PMI. Why not? The surprise slide. Oh, there we go. Thank you so much. There we go. That goes back to the early 1980s for you. 10-day vol on silver. Okay.
Yeah, let's get more on the data, right, that we saw. That surprise slide in Chinese factory activity that we got over the weekend. The official gauge sliding into contraction once again as the economy struggles to pick up momentum. Let's bring in our China correspondent, Min Lo, breaking down these numbers for us here. How bad were they?
Well, the official numbers were really bad. We're talking about missing the non-manufacturing PMI, missing every single analyst estimates out there. The manufacturing PMI, there was one economist who placed his bet like far away from everyone else, and he came close to the actual number. But we're talking about 49.3 for the manufacturing, 49.4 for non-manufacturing. So this is a huge contraction after the last quarter GDP showing a very slow growth, the slowest since post-COVID as well. So the scale of this shift really shows you that is beyond what a normal seasonal contraction is like in January, just ahead of Lunar New Year, because typically we do get that contraction ahead of Lunar New Year when factories go on break, but it shows you that demand is really soft and businesses are really not confident about the future, and they're calling in some ways for more stimulus from the government.
Any commentary that's come through on these numbers?
Well, as I mentioned earlier, that the scale of this is really surprising, and I think we have to see what happens in the next few weeks and months, especially as we head towards the National People's Congress, right? Because if you look at, for example, the GDP goals set by all the different provinces so far, most of them have set their GDP lower than last year. So economists are now forecasting that China's growth could hit maybe just 4.5% this year. And if the government doesn't set a higher target, perhaps, what does it mean then in terms of stimulus, right? Economists are not expecting very, very aggressive stimulus in the coming year, although our in-house analyst Chang Shu, our economist, is saying that perhaps we could see more rate cuts coming, and February, March, just between Lunar New Year and the National People's Congress, that could be a window for more rate cuts.
Min, thank you. Our China correspondent Min Lo there, breaking down that activity data for us, or at least the PMI data. Coming up, we're talking more about India's budget proposal to increase taxes on equity derivatives, putting pressure on domestic shares. Now, details of the measures outlined by the finance minister. Coming up next, this is Bloomberg.
I think it's a relief that Trump selected Kevin Warsh. Yes, he was a hawk for a period of time when he was a member of the Fed.
It's not so much that he's hawkish, it's that he's always hawkish, and always, typically when he's wrong in the same direction.
And he has become less hawkish over time. But I think it's probably going to reassure the markets.
It seems like he would be amongst the four candidates that were under consideration, the less likely to be interventionist on the balance sheet.
I mean, what you want in these positions is someone that has an open mind, that's a flexible thinker. So I think his newfound dovishness looks very suspicious.
It's going to take some time for Kevin Warsh to effect a plan of action that tries to engineer lower rates.
All right, a bit of a mixed review there when we heard from some of our guests following President Trump's decision to nominate Kevin Warsh as Jay Powell's replacement at the Fed. We've also heard some opposition from Capitol Hill as well. Senator Elizabeth Warren is the top Democrat on the Senate Banking Committee, and she questions Kevin Warsh's independence.
He has been known as an interest rate and inflation hawk for years and years, right up until Donald Trump wins the presidency, makes clear that he wants a Federal Reserve chair who's going to lower interest rates. And suddenly it appears that Kevin Warsh has had an epiphany, and everything he thought in all those years beforehand, he no longer thinks.
Meanwhile, Republican Senator Tom Tillis told Bloomberg that Kevin Warsh is qualified, but he plans to oppose the confirmation until the DOJ's inquiry into Fed Chair Jay Powell is resolved.
This is all about sending a signal to the markets and to the business community that Fed independence is critically important. And going after the chair, I think, took a stool out of the foundation of people's confidence, or a leg out of the stool. In the case of Cook, I do believe that it's another example of a trend, and the Senate has to stand in the breach.
And former Atlanta Fed President Dennis Lockhart says Kevin Warsh could face early committee tensions with rate cuts uncertain, but one later this year possible. Lockhart also told us that Warsh is seen as hawkish on inflation and the Fed's balance sheet, but his ultimate approach may remain data dependent.
You know, his history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates, as well as the balance sheet. And he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets, which is, of course, would be interpreted as tightening. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May. I think probably he will be data dependent and with the committee will make the best decision he can.
Given that there are 12 voting members on that committee, how significant is the influence of the Fed chair, and what do you expect to be sort of the direction going forward in the next 12 months?
The Fed chair enjoys a great deal of deference from other members of the committee. And in my experience, when it's a close call, the chair's preference often prevails. Having said that, a new chair has to earn the respect of the committee. And so I think he's going to have a honeymoon period. And during that period, he'll be trying to conduct himself in such a way that reassures the committee that he's going to be independent. And we'll see how that plays out. I think Kevin Warsh will be navigating some tensions and some conflicting views on the committee. So it's not an easy road for him in the first few months.
On the data front, there's talk that we could see inflation creeping back up. Certainly from the likes of PIMCO, that seems to be their assessment. Is there a chance that we don't even see a cut this year?
Always a chance, particularly when you're looking forward early in the year. There's so many months ahead of us that it's very difficult to predict. My personal view is no cuts in the first half, but maybe a repeat in the second half of some cuts that look a little bit like the last 2 years. But that's just speculation at this point. It will depend on how the economy evolves. And we have both elements of the dual mandate, inflation and employment, showing a trend, but not a trend that could not be broken by new events. So it's very hard to predict, I think, at this stage. One more cut is a reasonable and plausible assumption, I think.
There we go. Yeah, the former Atlanta Fed President Dennis Lockhart earlier here on our shows. Right, just an update, right? So we talked about Kevin Warsh, and arguably you could tie it all the way back to this time last week where you had a stronger dollar costing this sell-off across commodity markets. It's now spread generally to crowded trades, one of which has been Korea, of course. We're now getting a 3% drop on the index itself. It doesn't help that you have the Nvidia and OpenAI clarification that's come through out of Jen-Hsun Huang. Kosdaq index, the one is actually underperforming today across the FX space, which tells you, of course, the Korea angle here. Jakarta is also getting hit quite badly.
Yeah, it seems like this sort of sell-off has continued once again. When we take a look at what's going on in Jakarta, right? Indonesia is down another 5%. So it's not just the concerns of investability, but when you add this commodity price slump, that contributes, given it's a very resource-heavy economy. So certainly that is kind of leading the weight there and why things are looking a bit heavy. Nomura also downgrading, right? Stocks to neutral from overweight, and really citing the sharp increase in risks about the investability story, the outflows when it comes to passive funds after this MSCI warning.
It qualifies now for a trading halt at 5%, and I'm looking underneath the hood. To Yvonne's point, basic materials, energy, so the commodity component of this market, which really can't catch a break, is really dragging this thing down. Basic materials down 10%, energy's down 7.5%. Benchmark, as you can see on your screens, we're down 5% in the first 18 minutes of the cash market session here.
Yeah, and I think even for Nomura's Chetan said, they said, the fact that MSCI came out and even talked about the potential downgrade of this market to frontier market status, that was even a surprise to them, that this could be a possibility. I think that was one of the big reasons why they did do that downgrade as well. Yeah. So that's certainly one to watch. We'll get you on track with what's going on in Korea, coming up an update from there. If you're a subscriber and want to rewatch all the segments that we've been talking about as well, feel free to check out TV Go on your terminals. You can also become part of the conversation. Send us instant messages. Check it out at TV Go.
Welcome back. Here are some of the big stories we're following. UK Prime Minister Keir Starmer has vowed to deepen ties with Japan as he traveled to Tokyo following a visit to China. Now, Starmer met on Saturday with his Japanese counterpart, Sanae Takaichi, agreeing to work together on areas including security, industry, and technology. They also pledged to strengthen the supply of critical minerals. Now, the Justice Department, U.S. Justice Department specifically here, has released about 3.5 million more pages from its Jeffrey Epstein investigations. The files show that some prominent figures, including Commerce Secretary Howard Lutnick, stayed in contact with Epstein longer than they had claimed. Now, the released materials also include emails and messages exchanged between Epstein and top Goldman Sachs lawyer Kathy Gormley.
Well, let's talk a little more about India now. The government has delivered a budget that sharpens Prime Minister Modi's strategy of shielding the economy from U.S. tariffs while maintaining fiscal restraint.
Fiscal deficit kam karne. The budget focuses on reducing the fiscal deficit and inflation control. The budget also harmonizes high capital expenditure and high growth. This budget reinforces India's global role.
Yep, the market certainly felt that on Friday, and actually stocks were slumping some 2%. We'll see how today fares as well. Let's bring in CJ Chakraborty, their Asia Equities editor, for more. It seems like the market was a bit taken aback, I guess, by the taxes that they were talking about when it came to some of these equity derivatives trades, for example. I mean, overall, what has been the market impact so far, you think?
Well, that's one way to put it. Definitely, the market was left a bit surprised heading into this budget, given the context that India was one of the world's worst performing markets at the start of the year, and we had seen more than $3 billion in foreign outflows. There was expectation that government will bring some sort of measures or intervention to boost foreign inflows into the market, but instead the market was left, surprised by the hike in transaction tax. Basically, it's a tax imposed on buying and selling of derivatives in the market. And the government says that it's done this basically to curb speculative trading in the economy, in the market. We know that retail investors, millions of whom have joined post-pandemic, have been, triggering a surge in derivatives trading in India, although lately those volumes had been on a downtrend after the regulator's intervention. So clearly the sentiment not so good after that tax hike, and that reflected yesterday with the worst budget day performance for the Nifty 50 benchmark index since 2020.
Anything else beyond the tax related to the market?
Well, a lot of people have been talking saying that the budget is probably good for the real economy because you see a focus, returning to capex spending, infrastructure spending, as well as, tax swaps for data centers. If you're a foreign company trying to give cloud services through data centers in India, you are getting a 20-year tax holiday now. So there are incremental steps that people feel or investors believe could be beneficial in the long term. But the disappointment clearly is for the more immediate term right now, given that corporate earnings have been slowing down and you have seen foreign outflows consistently over the past 18 months. And therefore, not so much incentive for the financial markets to feel happy, but perhaps the real economy may feel better about this budget.
Our Asia Equities editor, CJ Chakraborty, there in Mumbai for us. More, in fact, on the budget coming through, given the market reaction, and we'll see, of course, what markets do with that information in the next hour coming through. So we talked about how it was the worst day for stocks post-budget in some time. The real economy, how does that permeate into that specific story? Barclays will be joining us in about an hour from now to talk us through, of course, that specific aspect of the budget.
Yep, we're checking when it comes to movers here, and China Wanka is certainly one to watch this morning. So the shares are falling after warning that losses widened to a record. So they expect that full year net loss to widen to about 12 billion US dollars or 82 billion renminbi. There you're seeing the 8 shares falling about 4.5% here. So certainly the scale of settlement for real estate development projects declined significantly, they say. Gross profit margins remain low, helping to explain the loss. This is according to an exchange filing from Wanka. So it was a profit warning. It was expected according to some of the sell side here, according to Morgan Stanley this morning. But it was a much deeper core loss than even Morgan Stanley's below consensus forecast. So certainly that did disappoint the market a bit here, Dave.
Yeah. When you fail to impress even the biggest pessimist out there, tells you a lot. Okay, some of the telco makers here. So this is the impact that's being tied to a higher VAT here. So we're down about 4%. We're down across the board here, across the big three in mainland China. Very quickly, a glance at silver and gold and the equity markets, not just the ETFs, but the actual miners and some of the names here. And as you can see, so we're now right about in between the losses. We were down as much as 10 on Zijin Mining. We paired that substantially, but we're still down about 5% on that specific name.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break. And yeah, we're seeing a bit of a retreat here when it comes to Asia equities this morning. We're down about 1.5% in the broader gauge. But Japan is actually holding pretty steady in the face of all that as well. Perhaps that weaker yen story is helping now that we are around that 154, 155 level. So that certainly is helping the equity space here this morning. But certainly there was those comments from Takaichi where she basically had to come through and said, give a bit of a clarification. Did kind of send a bit of a whiplash across to FX markets too as well over the weekend.
I mean, we came into work this morning and on any given day, you literally have 5 or 6 top stories that if it were not for that massive
we would have been
meltdown,
talking about this.
We would have been talking about this. And yes, but that's where we are. In fact, it's so much so that when you look at the earnings reaction that coming up on your screens very shortly, fine, the earnings were not as good, but the reaction function of the market is slightly more attuned to sensitivity today to the downside. If you're surprised at the downside, you are getting punished a lot more than you are the opposite, at least for today. Nomura down about 5%. ANA is the opposite, of course, 3.5%. Laser Tech was the one that went red earlier on as well. We're down 10% on that. That's also down to an earnings story as well. So, yeah, just to underscore that. But broadly speaking, I think we're doing okay in Japan relative to other more tech-heavy markets like Korea. Hang Seng Tech Index is also taking quite a big hit today. In fact, 2.4%, top row, leftmost side. You see that on your screen. So everything tech, everything that's tied to materials or energy, in this case, we're down 3%, is really getting dragged down substantially this Monday.
As you mentioned, right, it's rare to see at this time of day that U.S. futures are so low, or at least moving in the way that it is.
Yeah.
The pronounced moves there. So we're down 0.7%. That's the Nvidia story, I think. Yeah. People are still questioning the level of commitment Nvidia has with OpenAI and the investments and the like, given those comments from Jen-Hsun Huang over the weekend. Autos is certainly also a weak spot in these Chinese markets here today. Take a look at some of the numbers that we got when it came to BYD. Sales dropped 30% in January, and underscoring challenges for China's EV industry, including a winding back of subsidies that is hurting demand. Let's bring in our Asia Transfer reporter, Linda Liu. Linda, this is a pretty big drop in car sales. When you're talking about the start of the year, is this going to set the tone for the rest of 2026?
Yes, I think this is probably a worrying start to the year, even though usually the start of the year, around Chinese New Year holidays, sales are usually very slow. But for BYD to experience a 30% drop in monthly sales, I think that just points to how much demand has been hurt by the winding back of subsidies in China. That's, scaling back of a trade-in subsidy that really boosted EV demand, as well as the reintroduction of a purchasing tax on new energy vehicles in China.
Linda, so not a good set of numbers, also not a good set of numbers, though, from other car makers. Just compare and contrast what we saw from them relative to BYD.
Yeah, others have been doing better than BYD. Its biggest rival, Geely, managed to hold its sales steady compared to January last year. Sales grew 1%. So that's an achievement considering, how demand has been slow in this period. You've got Leap Motor, another EV upstart that's actually been able to grow their sales quite healthily. They managed to grow their January sales by over 25%. So you can really see the market dynamics continue to shift. The previous top performance might not be able to maintain their momentum, while some of the smaller players are coming in and grabbing that market share.
Okay, Linda, thank you so much. Linda Liu there, our transport reporter. Coming up here on shows, we take you live to the Singapore Space Summit. And we're speaking with GalaxySpace, China's first unicorn company in commercial satellites. Peter Huang will be joining us in a couple of minutes. You're watching The China Show.
All right, let's head to space this hour. Why not? And talk a little bit more about China's space ambitions, right? Now, you take a look at these images, right? This is from last October's Shenzhou launch of the Shenzhou 21, sending Chinese astronauts to the Tiangong space station. Now, China's space sector has been notching up plenty of firsts over the past few years. You take a look at the last just maybe 4, 5 or 6 years here. Of course, you had 2021, the rover landing on Mars. You had the completion of the Tiangong space station back in 2022. And then 2024 was the landing on the far side of the moon, which was quite a highlight as well. And just last year, launched that mission to collect samples from an asteroid. So what's next? What's the next milestone? We have a lunar probe this year and the Tiangong-3 mission in 2028, which aims to return to Mars. And in 2030, a crewed landing on the moon. Meanwhile, private companies are increasingly expanding their footprint in national space programs, supported by rising demand for launches and related services. You're talking about commercial satellite launches soared 7-fold during the time of 2019 and 2023. And where you're seeing a lot of this is China, India, Japan have really started to ease their investment barriers there. So, and what are the emerging players to watch out for as well? You talk about India, South Korea are also scaling up and also in the race. Dave.
Amazing. Yeah. Let's get more now from Singapore's first space summit and really what's going on in the industry. Adriel Hong is there with her next guest. Adriel.
Yeah, guys, I mean, this is really an industry that is in its early stages. We want to talk to the key players as this is getting going. Peter Huang joins me now. He's General Manager of International Business Development at GalaxySpace. Great to have you with us, Peter. Thanks so much for taking the time.
My pleasure.
My colleagues have just been talking through some of the milestones for China's space development. You're involved in some of these mega constellation projects. Talk to us about the role GalaxySpace is playing in all this.
Okay, so GalaxySpace, we are a Chinese commercial company. We are into satellites, so we have some key technologies. Satellite communication, satellite remote sensing. So we deliver some products. We also deliver satellites. So far, we have launched to the space for more than 40 satellites. We are going to launch more in the space. China is actually growing very fast for constellations that you mentioned. There are several mega constellations coming up, and it's great that we are in this track and we are making efforts to make our products innovative, cost efficiency, so that we can actually also having more contract orders in the short term. At long term, we want to kind of also make more innovative products for different, let's say, clients, either domestically or globally. That's kind of the things we are doing right now.
Domestically, what are you seeing in terms of the tailwinds from the sort of government policy support and the ecosystem for the space industry in China?
Yeah, right now I think the policy side are really having a good environment, creating a good environment for private companies, especially commercial companies like ourselves. Because space industry is an industry that needs kind of the top policy structure, and which in China, the Chinese policy is also encourage the private sector to develop more, to involve more in the commercial business of space. And we are one of the company who are actually doing great. And you know, in China, there is a central government level, there is a provincial level. I think each level of the administration are doing great to creating a good regulation structure for us. So companies like ourselves are really also enjoying this kind of overall macro environment to develop, to focus on industries.
So I wonder what the potential headwinds you foresee for the company might be. In terms of you getting all these satellites up there, right? How are you getting your kit into space? How are you launching all of this?
Yeah, so for us, right now, we manufacture the satellites. We then resource for the launchers to launch to the space. And we consider different options, depends on different, let's say, rocket providers, quotation, or let's say the offers, right? But I think the biggest challenge right now in the industry is also regarding to international coordination. Because for each every spacecraft launched into the space, you need a kind of spectrum, you need a coordination among different players. That's where I think we are expecting for more collaboration with different players, either from the private sector or from the government sector. We need more collaboration with operators or the players from all over the world.
You talk about global players. This is a space, pun unintended, where US, European leaders, they have been leading in terms of the early deployment of satellites. What is China's and your company's edge in this?
I think for our company, we started from 2018 as a private company. So when we started, we evaluated where we can do the best. Then we found out that it's the key technology we should work on. So we started working on some of the key technologies in this industry. For example, the satellite communication technologies. So we have actually achieved very well technology breakthroughs in satellite broadband communication, in satellite direct-to-cell technologies, and also massive solar panel systems. That's the energy part for the satellites. So we make those technologies mature enough for deployment. And then one of the strengths of our company is we try to also make it cost effective. So we built our in-house facilities, flexible smart factory to produce satellites. In that way, we reduce the cost without compromising any performances, so that we can actually meet the demand and develop the satellites in the long term. So that when we do it in a commercial way, we do it in a sustainable way. That's what we are looking at.
So could you give us ballpark figure on, compared to what else is in the market, how much cheaper are you able to make things?
Yeah, I think just use one example. There is a critical component of satellite called antenna, the antenna for communication. When we started in the market, such kind of antenna has a weight more than 7 kgs, 7 kilos. So with our innovation and our optimization of design of such kind of antennas, we successfully reduced the weight of the antenna, half of the original weight or the original mass. So which is a very big cost saving, because as we know that when we launch everything from ground to the space, it needs a very heavy charges on the launching services. So once we reduce the antennas to not even to up half of the original weight, we are actually reducing the cost of 50% through this angle only. And there is also another technical innovations which further reduce the cost while actually improve the performance of those antennas to improve the throughput of the satellite, which again is a cost saving against the original satellite communication. That's how we may make the satellite communication services more affordable than the original players or the traditional way.
That's a significant number in terms of cost savings. This is coming at a time where it's not just crucial in terms of governments backing the sector and perhaps giving the contracts, but the private sector, to your point earlier about commercialization. And I know that recently you guys had a contract with Thailand's telco, True. How important is that part of the business for you, and what are the key markets in Asia that you're exploring?
Yeah, right now, as a commercial company, we are still exploring the global market. Let's say we just get started, and but we have some unique offers. We have a constellation trial network where we have some satellites in the space. Using those satellites, we can actually conduct lots of validations of technology, also the applications of the satellite's internet. So with our collaboration in Thailand and other countries which are coming up, we are able to actually collaborate with the local players. Either it's the telecom player or it's the space players. We can actually collaborate to validate the technology and to actually apply our satellite internet in the local industry to looking for the needs or the demands, the real world use cases. Because in the end, we need the use cases to be commercialized, so that the use cases will use the satellite services. That's how the space industry gets its own commercial closed loop. We have to find the real demand, the real needs, and we also have to understand the pain points of those end users. So that's why we need to go to different countries to establish collaboration to get the right demands of the industry.
So what are the priority markets for you aside from Thailand?
I think for us, we are open to all global markets, every single market. That's kind of our interest. But for now, based on our evaluation of, let's say, economics, population, the gap of connectivity, we are more looking at like Southeast Asia, Middle East, Africa, and Latin America. Those are the regions where the economy is actually going up, while there is still, some connectivity gap, or there are some kind of high value needed for satellite connectivity. That's where the major markets we are making efforts on.
At the same time, you'll have to make sure that the satellite and the terrestrial networks are integrated, right? To your point about maybe doing a bit more research in the market and with working with the telcos. So how is that going to play out? How are you making sure that there is that integration as we look from 5G to 6G?
Okay, that's really one of the critical issues, or one of the biggest potential of our satellite industry. I think the most commercialized industry in space industry is actually communication. When we're moving forward, we want to create a network, a connectivity services that is ubiquitous, that is everywhere around the corner of the world. But this requires the integration of the space communication network with the terrestrial network. This integration actually needs more collaboration. The satellite industry needs to work, closely with the telecom industry, especially the telecom operators, because as I mentioned earlier, the frequency allocation, the spectrum, is one of the important things in this industry. We have to make sure in the first step that the space communication network does not interfere with the terrestrial network. We have to co-share the frequencies. But in the long run, with the integration of the space industry, a space-based communication network with the terrestrial network, then every one of us on the ground, we are enjoying the network, the smooth services around the corner of the world without getting any break. That's kind of the ultimate goal we are looking at with, let's say, 5G, or we call so-called 6G. Satellite communication network is going to be part of the communication system infrastructure.
Okay, Peter, one last question before we let you go. When it comes to space, the final frontier, we're always looking out for the next big thing. We know how this week, as soon as we could see another NASA project, Artemis 2, getting to around the moon, not to the moon, around the moon. You're excited about lunar exploration as well. What is China's role in all this that you see?
I think the lunar exploration is actually a very big trend. And either from China side or from US side or from other country side, I think most of the industry players and most of the ordinary people like you and me are all excited for the moon exploration. Going to the moon, I think, is going to be a dream come true for many people, not just in China, but also in other developing countries. So speaking from the China side, I think our country or the industry players are making very big progress. We are also did a lot for the deep lunar, exploration. And myself, as a fan of this industry, I'm looking forward that we will also have some another milestones. Getting to the moon or orbit around the moon first. Yeah.
Setting our sights on the moon. Peter, it's been great to chat. Thank you so much.
Thank you so
back
much.
to you guys in the studio for now.
Great conversation there, Averill, of course, with Peter Huang, International Business Development GM at GalaxySpace. Now, much more ahead from the Singapore Space Summit. We'll be joined by Indian satellite startup Pixel and Agnicol Cosmos, the company behind the world's first 3D printed rocket engine. This is Bloomberg. Well, Nvidia CEO Jen-Hsun Huang says the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. The Wall Street Journal earlier reported that the investment plan announced in September had stalled after some people inside Nvidia expressed doubts about the deal. Huang, for his part, downplayed the report, saying Nvidia will continue to invest in the ChatGPT maker.
Sam is closing the round, and we will absolutely be involved.
How much? Can you say how much? Can you say how much?
We will invest a great deal of money. Probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
Bloomberg has learned that Alphabet's autonomous driving unit is aiming to raise about $16 billion in a financing round, and that would value Waymo at nearly $110 billion. Sources say Alphabet will provide about $13 billion, while the rest would come from outside investors, including Sequoia Capital, DST Global, and Dragoneer Investment Group.
All right, a couple of levels to watch in silver. This one of our guests earlier on actually told us, you know what? Toss the fundamental story out the window. It's a technical scheme these next few days. Focus on the 50-day moving average, and as you can see, a closer look at this specific chart will show you that we've bounced specifically off that very level twice in the last two chaotic sessions. So far, that support has actually held. It's something to watch as we make our way. As Europe wakes up to this, and we'll see whether the support manages to hold for now.
Yeah, and you're starting to see, right, what the potential spillovers from the sharp drop in precious metals is going to be, right? It's in the rest of the commodities complex.
Yeah.
You take a look at what you're seeing when it comes to Brent, copper, aluminum. Certainly those are still looking like a bit weaker here today. We talked about the gold futures at least stabilizing a bit as well, and we have come off some of the initial falls and drops from the spot prices. And also when it comes to, it's not just it's the FX story too, right? Because, the precious metal drop had a lot to do with the dollar strengthening. And you're seeing that once again being quite pronounced when it comes to the Korean won, for example. Before we get to that is impacting Korea, right? I mean, just take a look at what we've been seeing when it comes to the Kospi. And the weakness that we're seeing in the Korean won is one thing to watch, but then you have to look at what's been going on in the whole AI, hardware sort of game, right? And you're seeing SK Hynix, Samsung both falling quite substantially here today. Maybe it has a lot to do with what the Nvidia comments that we heard from Jen-Hsun Huang as well. And that's certainly one thing to watch. But we're at 14.57 for dollar Korea here right now. It is one of the underperformers in terms of the FX space here today.
It really was not. It's not the best time to be one of the last few in the door on crowded trades across the world, right? So, and I think Korea is a good example of that. We talked about gold, and somewhat of a note when you look at the gold levels right now between the futures and spot, right? So there is some order in the chaos. So I think when you look at the spread between gold and futures, we're now snapping back between. So there's a little of a spread there. Just to note that because after we had a massive blowout between the spreads between the two. We'll just end a look at Indonesia, of course, a market that we have been tracking still, and this market can't catch a break, and we're down today on the back of the metals and commodity component of the story also pulling this one down. The rest of the region not doing too well. MSCI Asia Pacific, first day of the week, we're down 1.6%. A lot of that drag also coming through in the form of a very weak session across the tech place today. Plenty more ahead. This is Bloomberg.